And in our top business story, as investment in oil exploration and production dropped by $200 billion last year, the International Energy Agency has warned that the lack of oil project investment could create instability in the oil market in the coming years. As Brent crude was trading at around $46 per barrel on Tuesday, officials revealed details of the annual World Energy Outlook report, which states that if new project approvals remain low for a third year in a row next year, it will become increasingly unlikely that demand and supply can be matched in the early 2020s without the start of a new boom or bust cycle for the industry. Figures revealed by the IEA show that after peaking at $780 billion in 2014, investment in exploration and production dropped significantly last year and should drop by another $140 billion this year. It was also revealed that last year, the approval of the development of new conventional crude projects was at its lowest since the 1950s. The IEA estimates that $700 billion in investments in exploration and production are needed per year, and $80 per barrel is the price required to balance supply and demand of oil in 2020. Both the IEA and OPEC see the demand for oil to grow through to 2040. At the same time, the IEA sees natural gas use jump by 50% as nations try to meet increasingly demand for electricity and reduce use of heavy polluting coal. The oil market has been plagued for the past couple of years by oversupply, with the price of a barrel of oil plunging from $100 in mid-2014 to under $30 at the beginning of this year. The Middle East will require additional power capacity of 267 gigawatts by 2030 as energy demand grows due to an increase in population. That's according to the latest outlook. And in the UAE, the growth in power demand will be among the highest in the region. German company Siemens made the announcement, adding that the region's capacity will grow to 509 gigawatts from 307 at present. That's an increase of 66%. The CEO of Siemens Middle East and the UAE was quoted saying that the Middle East's growing population increasingly requires reliable and efficient power supply. While the share of renewables in the region's energy mix is set to increase, they also see natural gas as the main source of power generation by 2030, with energy-efficient combined cycle power plants leading in new capacity additions. It was also noted that solar energy will also gain momentum, with around 16 gigawatts of capacity additions expected by 2030. And by then, the UAE's installed power generation capacity is expected to reach 60 gigawatts, comprising of 44 gigawatts from combined cycle power plants and the remaining 20 gigawatts from simple cycle power plants, renewables, nuclear, and others. The CEO added that the UAE has a perfect strategy to diversify into several fuels, but gas-fired power station is still the most economical way to generate power. Office rents over in Abu Dhabi have fallen to their lowest point in more than 8 years. That's according to property broker Azteco. The property broker revealed that average office rents in prime office buildings in the capital fell by 4% in the 3 months to the end of September to 1,600 dirhams per square metre, as companies in the capital continued to feel the pinch from an economic slowdown caused by 2 years of declining oil prices. Azteco said that office rents in the capital are now 72% lower than they had been at their market peak back in late 2008. John Stevens, Azteco's managing director, was quoted saying that low oil prices leading to government budget reductions and job cuts have negatively affected overall market sentiment. Office rental rates were under pressure this quarter, with indications that tenants are either downsizing or moving to more affordable premises. The reduced demand led to an increase in vacancy rates, which will put further downward pressure on rental rates going forward. It was also noted that average apartment rents on the Corniche were down by 9% compared with a year earlier and fell by 3% over the quarter, while high-end apartments in Khalidiyah were down by 8% over the year and fell by 1% during the quarter. Etihad Airways and Hong Kong Airlines have expanded their codeshare agreement to enhance connectivity to routes in Europe and New Zealand. Under the expanded codeshare agreement, Hong Kong Airlines has placed its HX code on Etihad Airways flights between Abu Dhabi and a number of the most visited cities in Europe and North America, including Paris, Dusseldorf, Frankfurt, Manchester, Milan, Munich, New York and Zurich. Etihad Airways has placed its EY code on Hong Kong Airlines scheduled flights between Hong Kong and Auckland. The two airlines have obtained regulatory approval to codeshare on 9 additional routes, bringing the total number of services in their codeshare agreement to 14. Commenting on the new expansion, Kevin Knight, who's the Chief Strategy and Planning Officer at the Etihad Aviation Group, was quoted in a statement saying that the expanded codeshare will drive commercial opportunities for both airlines by offering business and leisure travellers enhanced connections and a more frequent service between Australasia, Asia, the Middle East, Europe and North America.